Many people think you need to be wealthy to take advantage of capital gains tax breaks, but there's a hidden gem in the tax code that can be absolutely game-changing for early retirees. The 0% capital gains tax bracket is like a secret passage in the tax code that allows you to generate substantial retirement income without paying a single penny in federal income taxes. What is this 0% capital gains tax bracket? Well, this 0% capital gains tax bracket is exactly what it sounds like, a tax rate of 0% on your long-term capital gains in qualified dividends. Now, for 2025, this remarkable benefit applies to taxable income up to $48,350 for single filers and $96,700 for married couples filing jointly. Here's where it gets really exciting. When you factor in the standard deduction of $15,000 for single filers and $30,000 for married couples, you can actually have total income of up to $63,350 as a single person or $126,700 as a married couple and still pay zero federal income tax. So how does this strategy benefit early retirees? Early retirement creates a unique tax situation that's perfect for exploiting the 0% tax bracket. When you retire early, you typically have little to no earned income from employment. No Social Security benefits, and you're not required to take required distributions from your retirement accounts until age 73 or later. This creates what tax professionals call the tax trough years, a period where your income can be dramatically lower than it was during your working years. It's during these years that the 0% capital gains tax bracket becomes your best friend. Let's look at a real-world example. So Bob and Mary are a married couple who retired at age 62 with $1.4 million in a taxable brokerage account. They need $120,000 per year to cover their living expenses. Here's how they can structure their withdrawals to pay zero federal income tax. They take $25,000 from Roth IRA withdrawals, completely tax-free. They get $30,000 in non-qualified dividends from their taxable accounts. Now that counts as ordinary income. $90,000 in long-term capital gains from selling appreciated investments. Now their total taxable income is $120,000. $30,000 in ordinary income plus $90,000 in capital gains. A $30,000 in ordinary income is completely offset by the standard deduction, and the $90,000 in capital gains falls within the 0% bracket of $96,700. The result, zero federal income tax on $120,000 of income. Here are some key strategies for maximizing the 0% bracket. First, control your income sources. The key to staying in the 0% capital gains bracket is carefully managing your total taxable income. Remember, this bracket is based on your total taxable income, not just your capital gains. If you have other income sources like part-time work, rental income, or pension payments, these will count against your 0% threshold. The strategy is to fill up your available tax space with long-term capital gains rather than higher taxed ordinary income. Second, tax gain harvesting. So unlike tax loss harvesting, which most investors are familiar with, tax gain harvesting involves intentionally realizing gains while you're in the 0% bracket. Now, this allows you to reset your cost basis in investments, potentially saving you taxes in future years when you might be in a higher tax bracket. Of course, you could take the income as well. Now, there's no wash sale rule for gains, so you can sell an investment in a gain and immediately buy it back, effectively getting a step up in basis for free. Third is tax loss harvesting. So since we're speaking of tax loss harvesting, it's important to know this strategy can be implemented to reduce your capital gains for the year. Tax planning throughout the year is important to ensure you stay within the 0% capital gains bracket. If your plan shows that you will be over the income and capital gains threshold, selling some holdings at a loss can bring you back into the 0% range. The wash sale rule does apply to sales at a loss. So factor that into your game plan. Fourth, asset location strategy. So where you hold your investments matters enormously for this strategy. You want to hold your most tax efficient investments in your taxable accounts, things like broad market index funds that generate qualified dividends and long-term capital gains. Keep your less tax efficient investments like bonds or REITs in your Roth or tax deferred accounts where their ordinary income won't interfere with your 0% capital gains strategy. These will have their own impact at a later time, which also needs to be planned for. Finally, timing your withdrawals. The beauty of having a diversified mix of account types is that you can control your tax rate by choosing which accounts to withdraw from each year. In years when you want to harvest capital gains at 0%, you might take more from your taxable accounts and less from your traditional IRA. There are two important considerations and limitations to keep in mind. Remember, state taxes still apply. While you might pay zero federal income tax, don't forget about state taxes. Many states tax capital gains as ordinary income, so you could still face tax liability even while paying nothing to the federal government. And healthcare implications also must be considered. Your income level affects your eligibility for Affordable Care Act premium tax credits. If you are using the Affordable Care Act marketplace for your health insurance, keeping your income low can help keep your premiums low. So let's wrap up with how to build your early retirement tax strategy. We want to start with the years before retirement, if possible. So to maximize your ability to use this 0% capital gains bracket, you need to build up your taxable investment accounts during your working years. Focus on tax-efficient investments. Like I said earlier, broad market index funds that will generate qualified dividends and long-term capital gains. Then comes the transition years. The years immediately after early retirement and before Social Security kicks in are golden opportunities to harvest gains at 0%. This is when you have the most control over your income and can structure your withdrawals to maximize the benefit. Remember, this entire strategy works best when you have multiple types of accounts to draw from. The combination of taxable accounts, traditional retirement accounts, and Roth accounts gives you the flexibility to control your tax rate year by year. The 0% capital gains tax bracket isn't just a tax break for the wealthy. It's a powerful tool that early retirees can use to create substantial tax-free income during their golden years. By understanding how this bracket works and planning your retirement income strategy around it, you can potentially save tens of thousands of dollars in taxes over your retirement. Key is to start planning now while you're still working to position yourself to take advantage of this remarkable opportunity. Build up your taxable investments. Focus on tax-efficient investing and work with a financial advisor who understands these strategies to create a comprehensive plan that maximizes your after-tax retirement income. Remember, tax laws can change and everyone's situation is different. The strategies we've discussed today are based on current tax laws as of 2025. I'm Josh Duncan, partner at F5 Financial Planning, and we specialize in helping people navigate the complex world of retirement tax planning. If you're considering early retirement or want to learn more about how we can help you achieve financial freedom for personal significance, I invite you to visit our website at www.f5sp.com